private equity capital is growing so much faster than the number of companies actually capable of absorbing it. And that's something that I actually found while I was doing the research for this particular investable business room. Initially, I thought that, yeah, there was a growth of that market, but not as big as that. And in actual fact, between 2025, which is already gone, and 2030, private equity is adding about $7.5 trillion in deployable capital. So this is something that we will see later on in the slide. Now, that's not hype, that's not optimism, that's not marketing. That's already embedded in the forecast. In 2025, private equity markets were just under $10 trillion. In 2030, they're projected to reach $17.4 trillion. And so private capital as a whole is expanding, but in particular private equities where the acceleration is most violent. Now, for many people will say, okay, this is really abundant. There's lots of abundance about capital, and yeah, absolutely. The numbers tell a story. However, this means more money, more deals, more opportunities. But beneath the headline, there's a very uncomfortable truth. Yeah, the number of businesses capable of absorbing that capital is not actually growing. In fact, it's shrinking. So there's a lot of money chasing businesses that are not able to show what investors want to be investable. Now, with that in mind, let me go to the slide I prepared for this. Just drop me a note and tell me if you're able to see this slide well, so that I can proceed as we move forward. Okay, I can see that you can see that. Okay, so this is effectively, I called it the High Valuation Code, and you will find later on in this presentation what is the High Valuation Code. It's a system that I developed since 2017 for university, effectively to make business fundable, to bridge the gap between founders and investors. You can see my history there. I don't want to necessarily talk too much about it. It's all about you today. So let's go to what I feel it's important to talk about. Why this room exists. Now, it's a fact that most businesses do not necessarily fail. They never become investable, unfortunately. That's the problem. Now, they might be making even money. They might even be making money, but because of the lack of education about what makes really a business investable, there is unfortunately an uncomfortable truth. This business will never become investable. And this doesn't just mean investors, it also means banks. How do you negotiate with banks, for example? That's something else that is not addressed as it should be, with the right education and the right financial intelligence in the business. Now, capital follows structure, not effort. Now, investors are not looking for just effort. They're not looking for passion. They're not looking for just hard-working people, effectively. They're looking for a structure, and they're looking for what we call transferable value. And unfortunately, most businesses are not effectively created with that in mind. They're not created to provide an investor with an opportunity for transferable value, and that's unfortunately a big issue. Let me come to the next slide. This is about the wealth created in the world. Yeah. So it's the global economic context. On the left, we can see the global GDP, which is in the ascendancy. We have about 105 to 110 trillion dollars of GDP created this year. That's the estimate. Now think about this. In 1998, I remember it was 33 trillion. So it's gone up 300 times, 300%. And Goldman Sachs has projected effectively there will be $227 trillion in 2050. So the growth is about 3.3% per annum. Now we got obviously some clear differences here. We got countries like India and China that are growing so much faster. Indonesia, Nigeria. So these countries are really making this is making most of the growth really. But the USA is contributing really well. The USA is obviously the top economy in the world still. Will continue to be for quite some time. However, according to Goldman Sachs projection, well, obviously China is getting closer and closer, but according to Goldman Sachs projection, we're going to have three big countries in 2075, which is 2 generations from now. They're going to be USA, China, and India. And so these three countries, they're projected to dominate the economy, followed by, surprise, surprise, Indonesia, Nigeria, Egypt, Pakistan. No European country at all in the first eight, according to Goldman Sachs. Now, this is obviously the source of this global GDP figure is coming from International Monetary Fund and Reuters. Now, let's come instead to what I think is more relevant to today. Well, let's talk about public capital markets. Now, public capital markets dominated by the USA. As you can see, they're even bigger than the GDP. With some people, they actually would worry about this. They would think that the stock market is overvalued because, when you got that kind of measurement, it's quite extraordinary to see that. The global stock market is worth more money than the gross domestic product of all the countries in the world. In actual fact, this picture is actually probably out of date because the valuation are changing so much because public markets, according to the latest, they are actually $250 trillion. They are large liquid and they are slow moving. Okay, so let's now consider this. I mean, the public stock market, they have valuation. They're obviously fast moving. However, the valuation engineering has happened with them quite some time ago. It happened when before the company got listed because the valuation process that they undertook did not obviously sort of get done while they were public. They first engineered their own valuation and then they became public businesses. Yeah. Now, let's come now to what is our really catalyst for today. It's really the big private market. Here there's a chart that shows how this is divided. We got about total assets under management of $13.5 trillion. Now, these are estimates. Yeah, don't count me on the exact numbers. So out of that, we go buyout, venture capital, growth equity, private equity, private credit, real estate, infrastructure and natural resources. Yeah. Private capital markets. So they're about 14, well, some people say 14, $15 trillion asset under management. Yeah. So they're the fastest growing segment. They are chasing businesses to invest and they're desperate sometimes because I speak to quite a few investors. I am myself a mergers and acquisition director. So I behave like an investor myself in many businesses. And we have difficulties in actually identifying. So we go through so many businesses, but very rarely we find something worth investing in. And this is coming from Korean P Insight. Yeah. So this is really the current situation. Let's call it current. Let's call it 2025. Okay. Now let's see what the projection actually tell us, the direction of travel, because this is extraordinary. Now, as you can see, from 2025 to 2030, the projections are unprecedented. So we're looking at private equity that is going from just under $10 trillion to $17.4 trillion. That's never happened in history. Obviously, $7 trillion addition to asset under managed private equity could not have happened before because obviously the economy is growing all the time. But this will really tell you how was such a big catalyst this is and why we are here today effectively, okay? So we can see that infrastructure are going to grow also quite healthily from 1.3 trillion to 2.3 trillions. That is the same. Real estate, not so much, but still growing. Now, the high valuation code, let me tell you about what's happened in 2024, 2025. Where did the money go? It went to infrastructure. Sorry, it went to infrastructure. Then he also went to artificial intelligence enabled business. So that's obviously another big area. Predictable cash flow. Okay, so that tells us already what an investor is looking for. Now, an investor is looking for predictable cash flow. Something I was mentioned to say before about capital markets, public capital markets. The value of the S&P 500 has changed completely in the last few generations when it comes to makeup. In 1975, the S&P 500 valuation was mostly made by tangible assets. Okay, so we're talking about 83%. It was tangible. 17% of the value was intangible. In 2025, the S&P 500 value is made 90% by intangible and 10% by tangible. Now, that's unbelievable to even think about what such a transformation has gone through into valuation. That tells us that the high valuation code is going to be more and more important because of the recipe that I'm gonna show you later on. Now, let's imagine two businesses. Sorry, I went a bit too far. Two businesses with the same revenue, very different outcome. Okay. Now, to the left is the low valuation outcome, and to the right is the high valuation outcome. I just put I drew here the red cross and the green tick here effectively. Now, what's the difference between these two type of businesses? Now, the business that is revenue led, founder dependent, no IP control, no succession, single market exposure. Obviously, they are not really preferred by investor, of course, yeah, because they lead to low valuation, low multiple, and sometimes no investment at all. So what we're looking for is structure-led, transferable leadership, IP monetized and protected, intellectual property monetized and protected, optionality built, capital ready. Now, one word I would like to stress here is IP control, intellectual property control, which doesn't necessarily mean intellectual property utilization. There are so many businesses in this world that make money without even using the IP, but controlling it. Yeah. Many examples. That's how big businesses really get expanded. The IP monetization is fundamental, whether you control it and you use it, or you control it and use it at the same time. Protection is obviously fundamental. And we will see how with artificial intelligence, this will become more and more important in our economy. And that's how investors, they're going to actually rank your business favorably or negatively. Okay, now let's come to a case study that comes from my career, actually. It's an hospital bed that should have made its founder a billionaire. And there was a big price mistake that cost millions. So case studies, hospital bed manufacturing costs $10,000, but the lifetime value to the customer is $10 million. Why? Because thanks to this hospital bed, it was about hip replacement operation. The patient was going home on the same day as the operation, and he was saving the hospital 5 days of hospital. And on a rough calculation, each day of hospital was worth about $1,000 to the National Health Service. We're talking about the UK in this particular case. So or the hospital in general, the private health system or the public health system, yeah. Now, this is a typical example of a lifetime value for a customer where you should really apply a lifetime value pricing. And let's have a look what that means. Now, the P&L with the wrong pricing is where you got revenue one-off $20,000, cost of sale 10,000, transactional $10,000, yeah? So you make $10,000 every time you sell an hospital that costs $10,000 to build, yeah? Now, this approach is what I call it donation of value because you are donating all the value of your technology to the customer and you're not making money out of it, yeah? Now, what is the P&L with the right pricing instead? The P&L would be slower revenue, and actual fact, don't make too much money one off. And I'll explain you a blue chip example later that everyone knows about, you know. So you make much slower revenue on a one-off basis. The royalties are $500 for each hospital treatment, okay? So every time there's an hospital treatment, $500, but the hospital is making $5,000 because they're saving 5 days of hospitalization. And the R&D tax credit is usually rewards those businesses that they do innovation. So normally you might have some money back from the government as well. Usually you do if you do these things. Plus management charges. Now the lifetime value margin, I'm assuming $1 million because let's say if you make $500 twice a day, $1,000 and use the hospital bed for 3 years, you get about $1 million lifetime value margin. Now, that's the concept of intellectual property monetization. And why is the customer going to be happy? Because the customer is getting $10 million lifetime value. So they're very well happy to pay you $1 million for obviously across 5 years, not immediately one off, of course. Yeah. The more they use the technology, the more they're willing to effectively be happy to pay you those royalty every time they use the hospital bed. Now, what's the one example that is very easy to talk about here? And it's actually Gillette, because think about this: when Gillette they sell the product, the razor is the one-off, and they don't make too much money from the razor. But the blade is where they make the money because the blade is where they actually they make recurring revenues and they effectively force you to use a product, yeah, because you bought the razor, now you have to buy the blade. I did say this to a number in a number of occasions. It's a bit like Gillette is selling blades in the same way as Microsoft is selling licenses. It's the same thing effectively. So you are exploiting your intellectual property. And believe it or not, one of the best way to exploit intellectual property for many of small businesses, I think there are many small business founders in the room today, is that you can actually create partnership with other businesses to create a winning joint venture. And just let me give you a very famous example, which is Microsoft and Intel. Microsoft was not really building microchip, yeah. Intel was not selling to consumer, but together they dominated the PC hardware market for many, many years. They were actually called Wintel, if you remember well. Now, let's go now to the real problem. The real problem is revenue does not drive valuation, not just revenue, because as we can see, you can actually sell, you can grow very fast, but the valuation may not grow. It may actually be a worthless business if it doesn't really respond to the high valuation code, which I'm going to show you later. Profit does not equal investability, as we will see. I mean, just think about Uber, think about Amazon, think about Disney. I mean, all these businesses, especially Amazon, they've been losing money for 10 years. Uber for 14 years, and they were still valued many, many billions of dollars. In the case of Amazon, we got to even a trillion. Now, growth does not give you capital confidence. In actual fact, I want to be actually blunt here. I actually spoken today, this morning, to a business that was growing so fast that they filed for Chapter 11. They grew 1,000% revenue, and because they could not manage their funding up, they ended up with Chapter 11. So yeah, growth is something that we need to talk about more, a lot more. And that's why financial intelligence is absolutely fundamental. I always say that we CFO, we have to stand up, really to understand that, it's on our shoulder to avoid this type of disaster. So this is actually repetition. Yeah. So what invest buy is predictability. Apology, I did this PowerPoint all myself, and obviously, as you can see, there's nothing particularly engineered here, so I did it all alone. So predictability, transferability, yeah. So they want predictable. They want a boring business, with where you can tell exactly how this is gonna sort of generate money, and it can be quite predictable. Not too many adventures, when it comes to revenue jumps, effectively. Transferability, optionality. Option is the opposite of dependency. There are so many businesses that go dependency. We're looking for optionality instead. When an investor sees dependencies, they just run away. They want to see optionality. They want to see a business that has got the transferability given by the leadership depth, really. And downside protection. So when you're talking about your upside plan, the investor is actually calculating the risk. Yeah. So that's a very, very important, mindset to consider. So bear in mind, yeah, this is very, very important. Yeah. Now, let's come to the next catalyst, which is artificial intelligence. How artificial intelligence is changing the stake. Yeah. What does artificial intelligence does? It accelerates upside, yes. Here is a picture of AI agent, the new organization chart of the future, where you will see AI agent effectively working and reporting to supervisor in the same way as human people. But it also magnifies weakness. So if your structure is wrong, AI will go from bad to worse. It can go from good to great or from bad to worse. Yeah, depending on how you structure in your business, really. It punishes poor structure. So that's what it does. AI. If you don't have a good structure, you will be unfortunately penalized, and the competitors will penalize you further because they will obviously take advantage of your poor structure. Now, ChatGPT, this is my words, yeah? ChatGPT is productivity theater. AI agent will create productivity. I know that this could be quite insulting for somebody, but unfortunately, that's the way I think about this, yeah? Now, ChatGPT will help you to write better email, better presentation. Absolutely. It will help you also to be more productive on your own. But if you do not have a structure, if nothing is documented, AI has got nothing to scale. And that's a very uncomfortable truth for many. So yes, let's obviously look for the, for the next AI tool that's going to help us to do better work. But it doesn't really increase your valuation of your business. AI agent will increase your productivity and eventually the valuation of your business. Yeah. And this is what Gartner has suggested. 40% of AI initiatives will fail because of lack of readiness. Effectively, yeah, this is about the lack of structure of many businesses. They're going to cause all these AI agent projects to fail, and that's a very uncomfortable situation to be in because unfortunately, that's exactly what's happening. Not enough documentation, not enough processes that allows AI to do the job. Because what you want to do with AI is to ensure that you go so much deep documentation about what you do, then AI can be delegated. So those AI agents can be delegated. Now, what's the origin of the high valuation code? Uh, it was designed in 2017 for the Plymouth University. It's about wealth creation with financial intelligence. Yeah. So you don't just create wealth creation, create wealth, and ignore financial intelligence effectively. The valuation is engineered. Yeah, it's not an event. It's not something. It's not a question that somebody asks you and you give an answer. The valuation is something that will be a process that will continue, will start and will continue. And you start the business with evaluation in mind, with an exit plan as well. It was designed to level up founders with investors. I'm going to show you a picture about the first time we did this was a pilot in 2017 with university. So the pilot was then followed on in 2018, 2019, and 2020 by Classroom, which unfortunately was stopped by COVID. And after COVID, obviously, we have created a different type of format, which this particular format is designed for CFO and founders, and obviously finance professional as well. So anyone who wants to really wants to really have a business with a high valuation strategy in mind. That also counts for solopreneur, by the way, because many solopreneurs, I've actually met quite a few of them. They don't know how to monetize intellectual property, and that's a very, very important factor for them, because it can really stop them. Even if they're not going to sell the business, they're going to exit. They're just underpricing. They're donating value. So what's the core principle? Capital allocates to structure, not effort, not growth, not stories. Okay, so we're talking about structures. Yeah. So investors are looking for the right way, the right structure that really create transferable value. Now, this is something that is an article I created a couple of months ago, because many people were talking about AI being the new electricity. So I've actually write quite a few articles here because I have a newsletter, as you know, that I've got 20,000 subscribers. Now, many people they are obsessed with generation of electricity, but very few are building the grid. Yeah, and without a grid, electricity doesn't go anywhere. You need to have a grid, effectively. So AI does not create valuation. Without a grid, it creates noise, cost, and operational fragility. And the grid is the high valuation triangle. And you can see it here. I put it here as a triangle. So this is the grid that will allow the electricity to flow in the right way. So let's start with the first part of the triangle, the IP monetization control. Obviously, these are taken from my article I wrote. Now, IP monetization is like the electricity generator. A generator produces power, but power that is not captured, metered, priced, and protected is wasted. AI without IP monetization is exactly that. Energy with no ownership, so it doesn't pay. So IP is about ownership, okay? Let's come to succession and leadership. Leadership and succession are the transformer, okay? So the electricity transformer. So AI without leadership depth centralizes decision making. So again, you're founder centric, you're unable to really transform the electricity as you want. Overloads founders, yeah. Creates single point of failure risk, which is something that investors really don't get involved in. Investors see this instantly. So if I intellectual property is power generation. Succession planning is what makes that power usable without burning the building down. No transformer, no scale. So you need absolutely succession leadership in order to scale. Yeah. Let's come to global optionality. Especially with AI, it's so important to be global today because there are no longer borders. Now, global optionality is a bit like the transmission line for the electricity. Electricity only matters if it travels, yeah? It doesn't stay in just one place, electricity. A power station serving one street is not an infrastructure business, it's a hobby. Transmission lines turn energy into economic systems. Global markets do the same for AI-driven businesses. So this is the way I can see how the high valuation code and triangle will actually create the grid needed for AI to give you the result that you would like to have from your business. Yeah, a high valuation strategy. Now, all five phases, there are five phases in business, which we're going to touch on a bit later. One is startup. And we can see how the high valuation triangle will behave in each one of these phases, yeah? Go scale up, stagnation, crisis, and exit. In a startup phase, IP is emerging. There's no succession planning because founder-centric execution is the norm. Global markets, global potential is theoretical when it comes to startup, yeah? It's too early. But in scale-up phase, IP must be formalized, protected, productized. Succession planning, the first level of management appears in this phase, and then expansion begins on global markets here. Now, when it comes to stagnation, normally IP is under leveraged. Then we go leadership bottlenecks that emerge. Global expansion stalls or was never properly executed. In crisis, IP is either misunderstood or ignored. The leadership is lost, and credibility or loss of credibility accelerates decline as well. Global markets and international exposure becomes a risk factor. When it comes to exit, IP is actually the valuation driver. And in succession planning, succession readiness is critical. And in global markets, global reach multiplies valuation. Now, the startup, I'm going to go I'm not going to really spend too much time on all of this detail, but I just wanted to give you an idea about the difference between the various phases. Startup is when you have effectively three phases: concept, development, and deployment. I just listed some of the reasons why startup fails. Yeah, you might be familiar with some of those. But yeah, sometimes it's really the inability to attract early investors, yeah, because they go no market fit product and they run out of cash and they got a weak business model or lack of differentiation sometimes, yeah. Now let's come to scale up, yeah. So here there are two charts. One is a good scale up, one is a bad scale up, one is a good scale up. Bad, generally speaking, not necessarily all the time. When you go sales, the blue line, and cash flow, the orange line. Sales are growing up, are very growing well, but cash flow is not responding. So the business is not really generating the cash flow that the growth is supposed to generate. While the scale up good is where we got more gently rising revenue and more gently rising cash flow. So the business is generating cash flow. This is some of the reason why we got failures in scale up. Sometimes scaling too fast, operation bottlenecks, cash flow crisis, RM mistakes, poor market expansion strategy. Let's come to stagnation now. Stagnation is where the sales are not really growing that fast. Cash flow is not responding either. So it's doing the same as the revenue. So we got market saturation, weak leadership, loss of competitive edge, and low investor interest and poor financial margin. So this is what stagnation looks like when it comes to list of causes for failure. Let's come to crisis now. Crisis is when the sales are falling and cash flow is falling as well. Got debt reliance. Sometimes that's the problem. Founder burnout. We got some legal compliance issue. Can cash burns exceed revenue effectively? So those are some of the reasons why crisis cause failure. Exit. This is where I effectively painted the picture of a perfect exit. The sales are going up, the cash flow is going up as well. There's a preparation phase, then there's a negotiation phase, and then there's an execution phase. As you can see, the cash flow generated goes up, but those three phases have to be effectively respected. Causes for failure of exit, no exit strategy, overvaluation, no buyer's interest, regulatory and tax issues. And what I would do now is I would just pause a little bit. If you got some question, please feel free to send them over, and you can use the Q&A part of the webinar as well. So obviously we covered a lot. We covered about the catalyst, the private capital markets, which are expanding. And we've spoken about really the high valuation triangle and artificial intelligence. Tell me if you got some question. I will pause for a bit here. You can also write on the chat if you like, or you can use the Q&A part of this session, please. Go ahead, yeah. What I will do while I'm waiting for some question, I will continue with this, okay? So as we said before, the high valuation code, okay? Let me check on this, yeah. So the question from Stevie, is brand equity part of IP? Well, effectively the intangible part of the business relating to the brand is absolutely part of intellectual property. Now, intellectual property is effectively your mode, effectively what makes you different from the competition, and the brand is what allows the customer to say, I'm choosing you instead of another business, instead of a competitor. So yes, and if we think about some famous example, yeah, say Formula One, for example. Now, Formula One is a brand that makes money not by using intellectual property, but by controlling it and let it use by other parties. Yeah. So that's where it becomes very, very complex, because many businesses they are able to monetize intellectual property in a different manner, really. But yes, brand equity. And in actual fact, this is where, in my view, also the accounting profession is looking to make some changes to this, because when it comes to accounting, we don't see on the balance sheet sometimes the intangible values and the valuation that should be mentioned. And that's something I've been speaking to quite a few other chartered accountants like myself. So yes, indeed, I saw actually a business that we were actually going to acquire, because I'm very busy with mergers and acquisition at the moment. And that business had effectively, the auditors were actually accounting through international accounting standards for the intellectual property of the business, for the brand of the business. And there was accounting which was actually audited, and the opinion was absolutely perfect. There was actually a valuation of $20 million just for the brand. Yeah. Maybe Stevia can also articulate this further as well. Yeah, if you like, on another message. I'll make a note of your question as well, because there could be so many case studies here that we could talk about. I'll send you an email about this after the call as well. Yeah, so that you will have a fuller answer, because on an occasion like this, you can only give a couple of minutes, but I think this subject requires probably a bigger conversation as well. Okay. Feel free to, I mean, while I talk, feel free to ask some more questions, because I'd be very happy to answer them. Yeah. So I'll be alerted when there are some more. Okay. Right. So what I wanted to do is now, so we can have some Q&A. Okay. Okay, sorry, got some question here as well. Yeah, also the Q&A, apologies. I can see them now. Gavin, how does this apply in the real estate segment for property developers? Okay. So can you just elaborate a bit better about how this applied? You're talking about the high valuation code, Gavin? Because obviously real estate. So we're talking about there are three big type of valuation method in business. One is cost, one is market income, and the other one is market. Cost, market, income. Now, real estate falls into mostly the cost part of the valuation. So effectively, real estate is valued by looking at the replacement cost for the real estate plus the ability of the real estate asset to generate income. So it doesn't follow the high valuation code in the same way as it does with with the let's say like in a tech business. However, let me tell you this: where any business, not just real estate, can actually create an high valuation code strategy. In even real estate business can do that if you create alongside your real estate business an additional revenue stream, for example, an ecosystem. Say, for example, if you're a real estate company and suddenly you start to sell, for example, your tenants. Say you're letting property, you start to sell tenant other things because you establish an ecosystem like insurance, like car loans, bank loans, and etc. Now that can actually attract a higher valuation for real estate businesses as well. So you can have actually multiple parts. This is why it's important for any sector to create more than one revenue streams. And any sector, real estate is the same. Yeah. I can actually have a further conversation on this game, and I'll make a note of your question as well, because yeah, there's a way for real estate to also have an income method as well. There's another question. How much attribution would impact PMF for emerging tech solution, given that if they spend 20 today, they potentially save over 500 in future from compliance issue? What do you mean by PMF? Sorry. Uh, if you don't mind, obviously elaborating on this. I can see your name, sorry, because it says anonymous attendee. So the question is how much attribution. Okay, then we go Raffaella. What's the trap founders fall into when they think they're building a high valuation business, but they are actually just dressing it up? Yeah, there are many traps, Rafael. I mean, one of them is when they can show growing revenue, growing profits. Unfortunately, what they tend to ignore is building transferable value. Transferable value is what actually makes an investor want to buy a business. And we see this so many times. We see that the business doesn't have a defensible IP. I always said, you have to protect and profit, so two at the same time. You don't want to be in a position where you just protect, you just profit your IP. Okay, so but on top of that, I would say it's the illusion that growth will give you high valuation. Growth does not give you high valuation on its own. I've seen it happen even this morning. I was speaking to a business, they were growing actually too fast. And I'll tell you this is a very important statement that I'm making here. Growth without structure is velocity towards risk. It's very, very important. Yeah. Andre, at what specific traction threshold should a governance plus escrow infrastructure business like mine move from interest in architecture to investable asset? Very unique situation here, Andre. So what I would do is I would make a note of this question, and because I need to understand a bit more, we need to ask you some more question about this. A governance plus escrow infrastructure business from interest and cash to investable asset. What I would say is because you're already considering an infrastructure business, the architecture should happen at the outset when you start the business. I wouldn't really wait one day to get the right structure, really. which again, especially if you're looking for investor, you may be looking for investor, for example, in a special purpose vehicle or in your holding companies, two different things completely. So we need to ask you that question before I can give you an answer. However, yeah, the answer is so move as quickly as possible as soon as you start your business with the right structure. Um, Another question from Andre. If founder builds in institutional grade infrastructure before revenue, does that increase perceived risk? And how should that be framed to investors? Institutional grade infrastructure before revenues. Yes, this infrastructure, institutional grade, will definitely decrease perceived risk. And that will be framed very positively with investors. I've done this quite a few times with in renewable energy. Before you actually start revenue, a couple of years, you're in the development phase. Before you go into construction and then utility phase, when you ask for money to the investor, is actually fundamental to have institutional grade infrastructure, really. So you need to show that you're going to run that plant for 25 years. You need to show that you're going to manage the assets well as well. And you're going to show that you're going to be reactive to any failure. Another question from Andrei. For infrastructure business, when does IP shift from being interesting to being valuation accretive? Is it protection, monetization, licensing, or revenue proof? Okay, infrastructure business, IP shift to being valuation accretive when you have passed the phase in which you just have a concept, you validated the concept, yeah. Now, in the case of infrastructure business, it's about having something that is monetizable. It can be either a permit to build or even an option on the land or a power purchase agreement, for example. That's where, for example, if you're selling energy, if you are producing energy, okay. But again, each case is different. But I would say this definitely not on the idea stage. It's on the validation stage of the idea. I always say ideas are great, execution is greater. How early should a solo founder start structurally reducing single point of failure, and what signal actually matters to investor? Okay, thank you for this. It's a very interesting question. Now, a solo founder should really move from single point of failure risk to effectively creating leadership team as soon as the after the concept is validated, you start to develop and tend to deploy. When you start to deploy your product on the market, you should absolutely find a way, no later than that, probably sometimes even earlier, no later than that. You should really reduce the single point of failure risk. Yeah. Uh, Andre, again, how do you know when the issue is in the business, but that you're speaking to the wrong type of capital? Well, obviously, the wrong type of capital. It's very important to first research who you're speaking to before, because, for example, you may be speaking to a fund that only invests in Switzerland and only in real estate. So if you're talking to them about tech, they're not going to be interested. Yeah. So you need to know, you need to research the investor first. You need to, how many times have I spoken to an investor told me, sorry, we don't invest in your sector. Then they don't invest in your geography. We don't invest in your stage. So they need to answer this question. First of all, what stage do they invest? Do they stage pre-seed, seed, Series A, Series B, Series C, startup, scale up, growth capital? I mean, one of those things effectively. Then what geography, what sector? Ask them this question before you engage in any conversation, because unfortunately, that's where there's a lot of time wasted. Rafaela, if you have to pick up just one driver the buyers truly pay for across most deals, what is it? And what evidence do you use to prove it's there? I would be tempted to say, Rafael, the high valuation triangle. However, because effectively, if you go intellectual property, but you don't have succession planning, the investor, they will not see transferable value. And if you don't have global markets, then you're quite limited. But I would say this: never underestimate the importance of intellectual property control. Intellectual property control will allow you to really get started. Then it's about really the leadership depth, ensuring that the business doesn't have really a single point of risk of failure, so that you can see that there is transferable value. Transferable value is really the most important matter here. Okay, and the high valuation triangle is the system designed to create that value for the investor. What I'll do, I'll gonna keep looking for questions if they come up. I'll continue with the presentation. And thank you so much for those questions. I'll be getting back to you with more detailed answer as well. Okay, so let me tell you about the high valuation CFO sprint. What is it? I would say also founders. Obviously, talking about CFO because I've been a CFO all my life, and obviously I know what financial intelligence can do to business. Now, at the start of this process, which I'm going to present you today, the CFO or the finance team is seen as a reporter. There's reactive finance and there is founder-centric risk. Yeah. So this is what really switches off investors. Yeah. When they see there's no financial intelligence. And this is a very important statement for me. Now, investors always back financial intelligence. Now, that could be a finance professional, it could be the founder who's financial intelligent as well. Yeah, very, very important. And in actual fact, sometimes they will invest in you only on condition that you will, for example, have somebody like a qualified CFO to deal with the investment. Yeah. Now, at the end, what happens? What is the result we're looking to get? Is the CFO becomes a valuation architect, because I said valuation it's not just an event, it's not just a number, is a process that it's like an engineering process effectively. Decisions aligned to exit outcomes. Okay, so that's very important. The business is priced for confidence, scarcity, and control. Okay, so so that's what the result we're looking to achieve with the high valuation. I call it CFO sprint. Yeah. Okay, so and what are the various phases here? So we got 4 phases. So this is a new system that is going live in 2026. Okay. So number 1, establish fundability, valuation foundations. So number 2, leadership and governance trust. Number 3, scale, capital, resilience. And number 4, exit, valuation, deal capture. So effectively, these are the 4 parts of this new system that obviously is based on the high valuation code, which I'm going to present you now. Okay. So these are the 4 main parts of it. So we've spoken about the 4 groups. Now let's start with the first group. The group 1 is fundability and value foundation. Okay. So we go 4 groups. This is the first one. Now, there are 3 parts for each group. So altogether there are 12. Okay. Now, the first one will answer the question why your business is not bankable. Okay, so what we're looking to do here, we are not looking to just negotiate with bank. I would say we're looking to out-negotiate banks. Okay, so we're looking to do better than what many people do. Okay, unfortunately, many people they do the opposite because they don't know how to negotiate with banks, and they end up getting charged as a customer instead of getting funded as an asset. Yeah. So you want to behave like an asset, not like a customer. So the transformation is the CFO or your finance professional becomes fundability literate. The outcome is the business passes first filter investor scrutiny. The second part of this group is IP monetization engine. So what's the transformation we're looking for? We're looking for a situation where capital blockers are diagnosed, they are not guessed, okay? So this is what we're going to get here with IP monetization engine. We're not going to guess why there's no IP. We're just going to diagnose it and we're going to resolve it. Yeah. The outcome is value logic is visible and explainable. Okay. So that's what we want. Again, these are the question we are answering so that the business becomes fundable and investable. The number 3 is revenue architecture blueprint. Okay, so the transformation is going to be that the value is articulated in investor language. So we want to make sure that this is where we really level up with the investor when it comes to how we're going to talk about this. Yeah. So the revenue architecture, what I was telling before, is how do you monetize your intellectual property? The outcome is revenue looks transferable, not fragile. Okay, so that's the outcome we're looking to do. So again, first outcome, the business passes first filter investor scrutiny, value logic, visible, explainable, revenue looks transferable, not fragile. So that's what we're looking to do with this first group, fundability and value foundation. Let's come to the second group now. The second group is about leadership, governance, and trust. As you can see, we go 4, 5, and 6 here, okay? Because I just numbered them. So this system this group of the same system start with founder dependency detox, okay? Because this is really a dependency that will create low valuation, unfortunately. The transformation is the leadership risk is reduced. The outcome is that we go a reduce key person risk. So that's an important outcome that we're looking to achieve here. Number 5 is board-ready governance framework. Yeah. So once we've done the founder dependency removed, governance builds trust instead of bureaucracy, and we go board level credibility. Okay, so that's what we want to establish. Investors will pay top value when they see this board level credibility after obviously reducing the key person risk. Many founders they tend to say, well, this is actually cost me too much, but in actual fact, this is the vision you want to have high valuation businesses. So number 6 is financial narratives that raise money. So the transformation is the CFO or the founder as well becomes institutional grade. The outcome is the numbers and story finally align. Okay. So these are all the 3 out of 6 very important factor for investability for a business. Let's now come to group 3. Group 3 is about scale, capital, and resilience. So what have we created here? Number 7, capital stack engineering. Now, capital is engineered, not reactive. Yeah. How many times do we see pre-seed where the founders, they give up too much equity or they constrain themselves into the wrong type of capital instrument, like say, for example, capital convertible notes. Then there are covenants and then you cannot get back from it, So that's unfortunately what happened. Instead, you engineer capital stack from the outset. You don't just wait for the moment when an investor comes, yeah? So the capital preserves control and upside. That's the outcome. You preserve control and upside for the capital. Number 8, internationalization readiness system. The CFO becomes a skilled governor. However, I would say also finance professional wants to become CFO. That's important for you as well, okay? Because each business is unique, We're talking about CFO mindset, CFO thinking. But obviously, this is where we want to really extend this to all finance professional. And growth increases valuation, not risk. Number 9 is risk and resilience architecture. Risk is controlled, not ignored. This is the transformation, okay? Now, the opposite of risk is an opportunity. So what we tend to do is to minimize risk, but maximize opportunity, of course, yeah? Again, showing a risk register is fundamental when you're talking to an investor as well. Then the outcome is business survives shocks and scrutiny, okay? Now, This is much, much more important than many, many people even think, because um, it's a lot more important to show reactivity to failure than just show a very clean business plan where there are no shocks, nothing is, so no risk is actually accounted for. Because the first question investor will ask you is what breaks first if things go wrong? And you need to be prepared for those questions from the investor, from banks as well. Yeah. Banks and investors is the same mindset. Okay. So we've done group three, scale capital and resilience. Let's now go to group four, which is exit, valuation, and deal capture. Now, exit doesn't need to be full exit. It can also be partial exit, where you have 100,000 shares and you want to sell 10,000 shares, especially in UK, we got some new instrument coming on into 2026. One of them is called Pisces. I've been speaking about that a lot on LinkedIn as well, and also my newsletter, where you can actually create a private listing for your business. And you can start the exit much earlier than you would do with public markets. So number 10, the exit is designed backwards. So the transformation is that the value is engineered backwards from buyers. The outcome is multiple exit option. Yeah. Okay. Optionality. This word is really important. Optionality. Unfortunately, not too many people use it. Building optionality is worth your wealth, millions, effectively. It's fundamental. Okay. So that's how you get the outcome. Number 11, valuation multipliers. The CFO becomes an exit and capital strategist. Now, usually, yeah, it's always the CFO, because even if you're a founder without a CFO, you want to make sure you got lawyers, you got your CFO, you go maybe also coaches as well when you do an exit. But the CFO is fundamental if you want to have a good valuation multiplier. As I was saying before, there are three steps in an exit. One is preparation, the other one is negotiation, and the third one is execution. Don't forget that any investor who comes to buy your business, they want to make money from the moment they buy your business. So not only you have to really engineer your own exit plan, you also have to engineer the exit plan of those who are going to invest in your business. Yeah. And then deal structuring and negotiation. Deals capture value, not give it away. And the outcome is realized wealth, not just a lines number. Okay. Now, this is what I do every day, to be honest, because I'm a mergers and acquisition director at the moment, and I do deal structuring and negotiation a lot. I will transfer that, obviously, that the experience I have, but also other people experience in this particular system that I'm going to present you now. Okay. Feel free to ask any question. This is all based around the high valuation triangle again, because we got the three levers, the three pillars of financial success. They're always the same. Number one, intellectual property monetization. Number two is succession planning. Number three is global markets. But as you can see, we're engineering around that because, yes, we want to build financial intelligence into your business. Yeah. Now, the CFO role has already changed. So the CFO as a reporter is, we can say that is the past and is not really what you want, okay? You don't want reporting, compliance, variance explanation, and historical comfort as an output from your CFO. It's an output from a team that report to the CFO, okay, but not from the CFO himself or herself, okay. What we want instead is the CFO as a valuation architect. We want to see capital architecture, optionality design, a risk asymmetry, and valuation control, okay. So this is what we want really from a CFO, and this is what will make really investors listening to you, speaking to you about your business. Because I use again the word optionality, very, very important optionality. Yeah. the opposite of dependency. You want to remove dependency and increase optionality all the time. Yeah. We've been speaking about capital architecture, been speaking about risk asymmetry and valuation control. Okay, so valuation is fundamental. Okay. Now, why are we establishing? I'm going to introduce now a cohort for this. Okay. Now, let's tell you this, the model is, so those 12 parts, they will start in, I'll tell you now the date in a few moments. They will start a cohort. Now, why a cohort and not consulting and no courses? Because consulting, you get the answer, but you don't get the ownership. Okay. And with courses, you get the knowledge, but you don't get the change because let's not forget knowledge is commoditized today. You go to the internet, you go to ChatGPT, you will find lots of knowledge, but knowledge is not intelligence. Intelligence is about using knowledge to create an outcome, which is totally different. Yeah. So acquiring knowledge is no longer a barrier for anyone because you can go to artificial intelligence today. So you can actually acquire knowledge as much as you like, you know. With a cohort instead, we get execution. We don't get excuses, okay? So that's what we tend to get with the course. So we get the real result that everyone is looking for, okay? So this is why I'm going to present you now with a cohort solution for your business and for you in general as a professional. So so let me go further with this. Let me share further. Sorry about this. So we got. Sorry. By the way, feel free to ask any question. I'll start again with the slide again, so that we can move forward. Can you see the slide still, please? Oh no, actually, yeah. There's the stop. So let me share the slide again. Sorry about that. So feel free to ask me any question at this stage about the 12 points that we've been speaking about. So there we go. So we got some question here. Oh, Andre, so some additional thoughts for RE business, grow across the value chain, grow service lines, or scale up geographically. Yeah, definitely. I'll give you an answer on this as well. Obviously, geographic diversification is very, very important for real estate in general as a business. So generally speaking, what we are able to say is that obviously each economic cycle tend to be quite similar across the world. There's lots of synchronization. But generally speaking, what we see is that a real estate business that is geographically diversified tend to be much more robust when it comes to valuation than any other business. So so let me get back to you on the CFO role. So that's right. Let me just take a moment. So document advance. Any more question at this stage before I move forward? Okay. Yes, Andre, is that okay with the answer? Okay. So sorry, Christian, do you want to bump on your question again? Oh, product market fit. Sorry, Nazmul. Okay, yeah. So product market fit is absolutely fundamental when it comes to really establishing your positioning. What I always say, there are two things that are really fundamental for a business, which is positioning and structure, and being able to establish the position of the business with product market fit is fundamental. And many startups, unfortunately, they fail on that when they are unable effectively to establish that the product market fit stage effectively. So most startups, they will actually fail because they don't find a market for their product effectively. So, and that's unfortunately happen more frequently than not. We saw before about various situation where this happens really a lot, and usually what I say is make sure that you're good technically as well as commercially. And usually I tend to introduce the concept of a technology readiness level, the TRL, and it tend to go through three phases. One is concept, which has got free TRL. The second one is validation, where you go another free tier, and then the third one is deployment before you actually go to market. You want to really meet the demand with a real study. Okay, so let me see if I can share again the PowerPoint that I was looking at before. Screen, there we go. That's fine. Here we are again. Okay, so basically, let me tell you why this works only in a small room. Basically, we want to have confidential capital conversation. So if you go 100 people in the room, you're not going to have capital conversation that are confidential. Real numbers, no hypotheticals. A peer accountability, but not content consumption, okay? So this is why a cohort will work well. Decisions are made and not postponed, okay? That many people that suffer from what I call the execution gap. The gap is where you got a great strategies, but great strategies are everywhere. Great execution is rare. That's why a cohort will help many finance professionals, many founders to to execute a great strategy. Okay, so who this is for? This is for founders and CFO. If you go capital or exit intent, you're serious about optionality. It's not for curious observers. It's not for early stage idea testing. It's not ideal for people seeking reassurance. Anyone not prepared to change the structure effectively. So this is those 12 stages are really not for this type of group of people effectively. Okay, so it's if you really are looking for those outcomes that I was talking about. Yeah. Okay, so the starting date is 10th of February 2026, and it's gonna end on the 31st of March 2026. It's gonna go on for 8 weeks. Yeah. So why start in 12 days? Because when you defer decision, they become a risk, obviously, and we don't want to do that. Obviously, as you can see, the private capital markets are traveling really, really fast. When you ignore the structure, that structure become a discounted structure effectively. Yeah. So that's something that you definitely want to avoid. Optionality, when it's delayed, becomes dependency. Okay. So that's a very a very common situation I can see with so many founders, so many finance professional. Thank you, Christian. I think you have to leave. Thank you very much for letting me. So yeah, delay becomes dependency. I'm going to open to any Q&A you may have. Feel free to ask anything, any question that you may have. Yeah, so feel free. I'm here available to you. And by the way, this is not the end of the Q&A because, as I said, probably there will be a need for further further explanation because each business is unique. Again, this is why I don't tend to do this room with too many people because it then becomes a little bit difficult to it becomes a little bit difficult to have a detailed answer to detailed question about a business in general. So yeah, obviously the closing thought is capital does not reward effort, it rewards architecture. But feel free to ask me any question. I'll be here waiting until you would like to go forward with question. So that's fine. Okay, so what I would say now we can, unless you got some question, I would close this session. Apologies if I made you late. It was going to be in 1 hour and a half. We're now 1 hour and 50 minutes almost, but that's because from LinkedIn there was a delay because many people they were sort of going through LinkedIn when they so the LinkedIn and they had to go through the Zoom link. So apologies if there was a bit of lateness on that, but it was great to have this webinar with you. I didn't want to call it webinar, by the way. It's an investable business room. So, and I look forward to speaking to you later on. And please use that email in order to really sort of ask me any more question. And again, some of the question you've asked me for, sorry, I couldn't answer 100% because I need more. I need more. I need to get deeper into your business is looking for. Especially you, Andre. I'll get back to you. Okay. So what I would say is this. Thank you very much for joining me today. It was great to have you, and we'll speak to you soon. So thank you very much, and I will look forward to meeting you at the cohort. Thank you. Bye.